I don't think we're necessarily chasing our tail as much as we're uh, iterating on an imperfect process. So the way we set up these systems creates less perverse incentives, I think, over time. But there's a learning process because we're dealing with a very complex problem. And the way you deal with complex problems is you iterate because you cannot anticipate every single way anything can go wrong. But that doesn't mean you should stop trying entirely because the alternative seems clearly a lot worse.
Welcome to The Regeneration Will Be Funded. My name is Matthew Monahan, and in this series, we're exploring the intersections of regenerative finance, technology, and our living planet. Created with Ma Earth, you can find all of our conversations and more at maearth.com. Thanks for joining us. Today's guest is Rez from SolidWorld. SolidWorld is a startup focused on scaling the climate finance markets by addressing a number of key bottlenecks and challenges. In this discussion, we go deep into the system design of SolidWorld and cover a lot of financial and technical details. It's clear that Rez is a talented builder and is really serious about this effort. I think we'll be hearing more from SolidWorld in the future. So if you want to get a comprehensive understanding of the project, you'll definitely want to check this one out. Let's dive right into the discussion with Rez from SolidWorld. Welcome, Rez. Rez is the co-founder of SolidWorld. Thanks for being here.
Good to be here.
All right, what is SolidWorld?
Well, SolidWorld on a high level is the warehouse for quality climate finance, as we express it right now. That essentially means we help carbon projects access funds for their carbon credits a lot earlier than we usually do. So in the carbon markets, you have this fascinating situation where you don't really get carbon credits looking forward. You get carbon credits for the activities that you've done in the past, right? Mm-hmm. So let's say you are a organization restoring mangroves in developing countries. Cool. Mangroves have pretty high upfront expenses to actually plant them. Mm-hmm. And then the payoff timeline for that project is quite large. It's definitely over 10 years. It's 15 years, maybe sometimes 20 years.
Right.
It can take a while to pay off. And then the question is, how do we move that timeline earlier? Mm-hmm. Because that makes these projects a lot more viable, right? And at SolidWorld, that's the kind of problem that we're tackling.
Mm-hmm. So financing different types of restoration, reforestation, planting, conservation projects that result in carbon outcomes, mm-hmm. rather than only getting paid for after the project is done and sequestering carbon. How do we actually finance and fund these projects?
Yeah, exactly. Liquidity is a big thing in the carbon markets because ultimately, what I personally believe, I think this might be a bit contentious in the carbon markets in general, but the thing I am seeing is that the harder a project is to finance, generally also the more additional and more real it is.
Right.
I mean, if you compare community-based reforestation initiatives, which don't necessarily, generate revenue by just chopping down the wood later, you end up in this kind of situation of, would this have happened without a carbon project? And right. The answer there is significantly more no than in that situation of, oh, hey, let's put up a eucalyptus monoculture forest. I'm sure it has right. no commercial purposes.
Right. So what you're drawing this important point around is that in this concept of additionality, which is key in the carbon markets, where it's like, would this carbon sequestration have happened without this intervention that mm-hmm. we're making? And if the carbon sequestration is being afforded by this intervention, then that's what results in this notion of additionality. And so when you look at projects on the whole, some projects are getting carbon credits, but still cutting down the trees at the end of the life cycle, for example, or blending kind of a timber, harvest with carbon credits.
Yeah.
And other projects might be trying to do permanent reforestation or protection and just purely relying on the carbon credit revenue to finance the thing.
Yeah, exactly.
And so if you're purely relying on the carbon credit revenue, it's even more important to bring that financing forward in order to pay for the actual planting and labor side. I would also make the point that larger institutions and companies are more likely to have financing and to have cash flow to do these operations, whereas small landholders who are often not participating in carbon markets are less likely to have these financing vehicles. And so it's even more important to kind of solve for this area.
Yeah. The second part of it is friction, right? Because if you are a huge corporation, you might be large enough to basically finance your own carbon projects everywhere. But like the smaller you get, the more basically impossible that becomes.
Right.
And even if you are a larger corporation, I'm going to describe basically the journey of an average sustainability initiative in these kind of organizations, right?
Okay.
So initially you're like, okay, I want to be super sustainable. I'm going to go out and get some carbon credits. You don't really understand what's happening too much. You end up buying something very cheap. There's a saying in the voluntary carbon market that what you don't pay in dollars, you just pay with your reputation. And I think that's materialized repeatedly over and over again, and I think it'll keep materializing. So you probably get burned once or twice buying carbon credits that turn out to be questionable. And then you're like, okay, so looks like we need a sustainability team because we need people to actually understand what's happening here. So you start hiring a sustainability team and then discover that these people kind of don't exist to the level of they understand the carbon accounting and they understand what's on the ground. Those people are very few and far between. So you end up spending a lot of time doing that. And then finally you get into this idea of like, okay, I'd like to also get in on the ground floor essentially and like do some upfront financing. But then you get even more noise because now you have organizations coming to you with these preposterous claims of, hey, I'm running a conservation carbon project on an entire country. If you only give me a bit of money, that's going to happen. So then you need due diligence. What you end up seeing is kind of almost these in-house sustainability investing venture teams get created that know how to navigate this space. But I don't think that's like a really effective use of labor because ultimately they make a couple of these decisions maybe a year, and that's kind of it. Is that a good use of everybody's time? Questionable, right? So I think the industry needs to get more standardized. It needs to have more frameworks. It needs to have more. It needs to be more out in the open so everybody could a bit easier understand what even they're dealing with. And I think if we lower the friction of participating in earlier stages of carbon projects, it opens up our ability to actually scale these harder to finance carbon projects further, which means we end up with more high quality climate action, which ultimately everybody wants. Because we can't keep relying on the kind of projects that seem to blow up almost every couple of months in the news, right?
Right. And so on that standardization, that's something that you've just recently released, as I understand, is a new framework called CRISP.
Yes.
So can you share a bit more about that?
Yeah, so CRISP stands for Carbon Risk Identification and Scoring Principles, which is a document we put together to describe how to identify the delivery risks of carbon projects, specifically nature-based removal carbon projects. So it's a framework which goes through all of the major categories of how a project might have a non-delivery situation or an under-delivery situation. So Specifically, what that means is if I pre-purchased 10,000 tons from you, but it turns out that you only are even able to create 7,000. We kind of have a problem because now somebody has to fill out some sort of replacement clause, or you take a loss. Both of those options aren't necessarily good, so we need some sort of frameworks to protect the industry from itself to some degree. Something we write about in that paper is, for example, Verra registry community reforestation projects, the 30-something we looked at on their first issuance. Do you know how much they under-delivered compared to their estimates of how much they're going to be able to deliver?
How much?
It's about 1/3 of the estimate, right?
God.
The median is 1/3.
So if they promise 10,000 or commit to 10,000, they deliver 3,000. 3,000.
Yeah.
Whew.
And in that kind of a space, it's pretty clear that you need these kind of third-party estimates of what is actually realistic for this project, and also what are the likelihoods of the project suffering some sort of bad events, such as catastrophic nature, events like tsunamis, like earthquakes, wildfires, etc., because all of these could stop the project from being able to deliver.
Right. And Verra's been subject to a lot of criticism in the last few months. The CEO just stepped down. If anyone from Verra is listening to this, excited to speak with you and would love to have more of a discussion. So what are the main things? You just mentioned earthquakes and fires. What are the main reasons why projects underdeliver?
Generally, the main thing ends up being overestimating the impact to begin with, because especially when we're talking about reforestation initiatives, what you have to do upfront is you do a lot of this kind of modeling of, okay, I have this many trees, this percentage of the trees are going to survive, this is how a tree grows, these are the ways this tree grows, this is how much carbon it's going to sequester. So it's a bunch of mathematical equations that get you into a rough ballpark. But all of those different smaller parameters can have a huge impact on the outcome. And when you are putting those parameters together, sometimes it might be in your best interest to kind of pick the ones that seem the most optimistic. For one reason or another, it makes the project seem a lot more viable and attractive and interesting and hyper profitable, perhaps. And the realistic outcome is, none of those parameters are exactly as nice as predicted.
And is there an incentive misalignment here where there's an incentive to make the numbers as big as possible up front to get the money and to get the commitments, and there's kind of an incentive for the buyer to see as much as possible so that they get to their net zero? I mean, they're paying for it, so maybe there's not that incentive, but I guess I'm wondering, is there structural incentive misalignment that's causing these types of miscalculations, or do you feel like we just don't have very precise science and robustness of the process?
I think the science is getting a lot better, and every time we see another one of these projects actually put their numbers out, we can learn from that, right? That's actually very important. All of these projects are kind of creating data, which is amazing. There is, I think, an incentive misalignment, but there's also just the fact that there aren't a lot of these kind of people that can manage these equations in the most accurate way possible. It is kind of a field of art and science on its own.
Absolutely.
And I think as a forward-looking note, a lot of the new methodologies I think are going to get a bit better at how all of these things are getting done. I'm very excited about remote sensing in general, but remote sensing can't be forward-looking in that sense, right? You can't use satellite imagery to look at the forest 5 years in the future.
Right. Well, I live in New Zealand, and the carbon tables that are used to effectively calculate the carbon sequestration of standing trees and forests are kind of universally acknowledged in the ecological community as being outdated and not very accurate, because they they don't look at anything below ground, for example,
or soils.
In terms of soils. And
okay. Got it.
you end up with different types of species being favored because of their fast growing characteristics. And so even like the tables and methodologies used in the regulatory environment, we know are not necessarily fully representing what's happening in nature. And so then to expect us to be able to all collectively forecast, it makes sense to me that it's still finding its way to accuracy.
In data science, we have this saying that all models are wrong, but some models are useful, right? And I think we just have to consider what is the use case of the model and what is it supposed to do. So if we have models that exclude, for example, some categories of carbon or have a tendency of systemically underestimating, from a forecasting perspective, that's actually favorable because you prefer to have pleasant surprises than misfortunate shortfalls, right?
Yeah.
So conservative estimation is how we should approach this, in my opinion, but that's not realistically, from a historical perspective, what has happened.
Got it. Okay, so the CRISP framework that you published, is that to help guide more precision around estimates, or is it predominantly to emphasize kind of considerations for what are the risks? And my other related question is like, so who is the target audience? Is it the corporate sustainability teams and buyers that you're trying to basically educate to be better at kind of understanding before projects, or are there other broader audiences?
Okay, let's go to the first question, which was
the
what
point
is
of the framework.
Goal of the framework? So the goal of the framework is to create this broad summary of kind of what are the risks involved in a specific carbon project. So the broad summaries are pretty important because from SolidWorld's perspective, this informs how we allow suppliers to come in and forward sell their supply. So, for example, if a project is located in an area extremely prone to wildfires or extremely prone to some other events which might cause huge reversals in the project itself, we need to understand that up front, so we could say, you know, this kind of forward financing where you're like committing to sell this amount right now with delivery in the future, this might be detrimental to you because the risk of non-delivery or having to fill replacement is just too high for this kind of a structure.
Right.
The other part of it is just, for example, yields, which is thinking about, well, we can only allow this project to sell up to this amount because if they go over that amount, the likelihood that they're going to have a shortfall increases with every new ton that they sell into the system, right? So we want to be very transparent on how we approach this, and we want to put the documents of how we came to these conclusions out into the public because we feel sunlight is the best disinfectant. I mean, organizations should be able to kind of double check our work and independently verify, but if we don't put the underlying framework out into the public first, then how are they supposed to do that, right? We have to go out and actually explain how we're thinking about these things because we need other people to be able to understand if they want to. I think that's very important in creating more robust systems where people can double check instead of, you know, it just being kind of, trust me, bro.
Right. So you're trying to put a framework out, not just for the buyers, but also for the project originators, the people who are doing these projects. And presumably this framework is underpinning the projects that are entering into SolidWorld's marketplace.
Exactly.
Before we get to that, another question about the under-delivery. So if a project under-delivers, you know, whether it's in, you know, maybe Vera's case or other examples, like what is the recourse? What is the consequence of that?
Contractually, how we've set this up is that you either buy back your own circulating supply in the system, you bring us essentially the tokens which would allow everybody to get paid back because all of the recourse is essentially denominated in carbon. And the last option here is that you come in with spot credits, which are actually already certified, which go into the same category, are the same level of fresh good credits, and you just offer those as a form of replacement. So those are the three categories of categories of recourse. The suppliers themselves can pick and choose and combine between the three.
So I have committed to 10,000 tons. I only delivered 5,000 tons, and so my recourse as a project that did not deliver on the carbon that I promised is either to buy those additional 5,000 to bring those credits that I received back into the market, or to find some other fresh high integrity credits that meet the standards to bring into it.
Yeah, that's approximately correct.
Approximately. Okay. What was not precise?
We need to get into the weeds about like how solid world system works in order to like understand one of these.
And does this way that we're describing it, is that roughly match how like Verra works?
Verra doesn't deal with like financing carbon projects, so in that sense, these are apples and oranges in that sense.
I see.
So
what were the recourse when you look at the carbon markets more broadly and you say, look at all these under deliveries? What's been the recourse for that?
It really depends on what the contract looks like. So we're dealing with a specific kind of contract to begin with. So in Solid World, the contracts are fully prepaid, which means that any money that exchanges hands now. I see. And the delivery happens at a specified later date. This is different from how a lot of other contracts might be constructed, which are maybe you only pay 20% upfront and then you pay 80% on delivery. So these are kind of different structures of deals because this kind of like 2080 model, for example, doesn't require that much of going too deep into understanding what is like a realistic amount that this project is able to deliver.
Yeah. Okay. So let's zoom in on Solid World. So what you're saying is that when the agreement is happening, the money is changing hands. So the buyer is actually paying for the full amount of credits that they're purchasing. You have these contractual obligations that manage and govern it, and that it's underpinned by this framework, CRISP, in terms of how you're thinking about it, Solid World, the risks and the considerations for ensuring as much of an accurate delivery of commitment as possible. How did the mechanics of Solid World work?
In a broad sense, when a supplier comes up to us and they want to sell a supply into the system, the first thing we do is the whole due diligence process. We look at all of the risks. We figure out, is this good supply? Is this a good supplier? After all of those boxes have been ticked, all of the documents that we have created gets put in front of this organization or community called the Curation Council, which are Solid World's liquidity providers for that category. So, for example, Verra mangrove restoration, right? And that Curation Council has the ability to veto any project coming in. So this is a sanity check that, hey, is this project equivalent to all of the other projects in the pool? Because a lot of what's happening here is that we're making these projects fungible, right? Like we're saying these projects are similar to these projects and they should trade at the same price ranges.
Right. So you have two different governing groups or councils. One is Solid World doing curation and another is the liquidity providers.
Yes.
Able to say, no, actually, we don't think that fits.
Exactly. Because the thing is, when you do fungibility, you can have a race to the bottom if you let in something that just completely misses the mark, right?
Totally.
Because if we're talking about the kind of projects that we're working with right now, mangrove restoration projects with huge community benefits that share a lot of the benefits with the local community, if you have a kind of different profile of mangrove restoration project come in with perhaps like very different unit economics, but also like maybe a lot more questionable benefits to the local community. Well, they can maybe afford to sell everything a lot cheaper, sure, but are you getting the same thing? No, probably not. Right? So curation is a really important part of how you make the carbon market fungible. Without that component, I don't think the voluntary carbon market functionally is, right? Because to some degree, every carbon project is its own perfect snowflake, right? It's unique in the sense of there is no other carbon project happening on the same piece of land.
Right.
There is no carbon project that interacts with the same group of people in the same way. So all of these things have to be considered, right, in order to reach this conclusion that, hey, this thing is $30, but that thing is also $30 instead of 20.
Right.
The thing about the a voluntary carbon market is that a ton is not a ton is not a ton, right? Like every ton is kind of priced differently because it's perceived differently by the market, because there's like more or less value perceived in it, right? Because we're in this kind of a situation where the stories and the behavior on the ground matter quite a lot. Everything has its own kind of process on what people believe it's worth, and it can be worth drastically different amounts to different people as well.
So I'm inferring here that in order to bring capital forward to scale and to be able to fund projects in advance of the outcomes, the part of the unlock here is to create this kind of liquidity pool that creates fungibility between projects. And so what you're describing are, your efforts to make sure that that kind of approach maintains integrity and likeness and fungibility between projects, where the claim that this can be substituted for that has enough substance and incentive alignment between the liquidity providers, and so that effectively you can create this pool of capital that creates liquidity and fungibility in order to afford the financing. Do I have that?
Yeah, exactly.
Okay.
So let's move on to the next step.
Yeah.
You get these tons issued into the system. The next step is how do you turn that into money? So we developed our own mechanism for dealing with this, and the thing you have to keep in mind is when we're talking about these specific forward contracts, a project that is 3 years away from delivery and 6 months away from delivery shouldn't get the same amount of money, right? Because if you're paying fully upfront, you expect a discount the further away you go, right? And because of that, we have a system where you essentially now exchange this specific project for this sort of fungible token. The one we launched right now is called CRISP-M, Crisp Scored Mangroves. So if you bring something very close to delivery to the system, you would get one crisp scored mangrove, but the further away you get like a fraction of it, right? So if you're 5 years away, for that ton, you might get like 0.6 something crisp scored mangroves for each ton you put in. And then that essentially decides the price, since you can now sell this token directly for money. So there's this sort of mechanism that now takes the time dimension and accounts for that, and is able to kind of price tons from 1 to 5 years away from issuance.
So if I were going to buy a ton that was delivering tomorrow, maybe it would be just one CRISP-M. But if I'm buying a ton that delivers 5 years from now, I only get a fraction of that CRISP-M.
Yes.
I see.
And the other way around, now if buyers want to come in and they want to buy that supply, they benefit from the same discount. So they can get that exchange CRISP-M for that underlying contract again.
So I can buy a ton for a discounted price because that ton is into the future.
Yes, exactly.
Does that create an incentive, though, where I would want to buy a bunch of tons that are way far off into the future instead?
Well, that would be fantastic, because ultimately that's if you're really incentivized to buy a bunch of tons out into the future, that's what the carbon market needs. It needs finance up front for.
But I can't retire those credits or make claims against net zero. because those credits, I mean, those tons don't even exist yet, and I bought them a fraction of the price, right?
Exactly. But that's what justifies the discount, right?
So how do buyers translate the CRISP M into their claims around net zero?
Well, they essentially lock in forward supply, so it gets delivered to them at a later specified date, and at that point they will be able to make these environmental claims. But the thing is, when we're talking about high quality climate action, this is quite an impactful way of locking in forward supply.
Brilliant! It just all clicked into place for me.
Nice.
Yeah. Okay. So basically, I can start to really pre-purchase now the credits 5-10 years away, knowing that I'm going to need to buy these credits in the future, and I want to do it in a way that is actually high integrity, and I want to do it at a scale that makes sense, and I want to get the best price I can. And so I can buy them now at a discount and then basically finance the high quality climate action that we need today and help smaller projects or projects that may be struggling with financing get what they need to do things like mangrove restoration. And in the future, I'll be delivered those carbon credits and I'll be able to, pat myself on the back, meet all the compliance standards and claim net zero.
Yes. Now, let's get to the third participant in all of this. So we've talked about the demand side, we've talked about the supply side, but there's something in the middle. There's liquidity providers.
Yeah,
right?
Liquidity providers. And this is also, I want you to bring in the Web3 stuff for those who are coming from more of a climate or carbon background, but not Web3. Why this is so important.
All right. So let's talk a bit about market making. So I'm sure everybody has... well, maybe not everybody has, but
all 12 people listening to this.
all 12 people of you listening to this right now, you've probably used like some sort of for example, like, I don't know, crypto exchange or like something like this before.
Yeah.
And the thing you interact with there is something called an order book, right? So like people list like, hey, I'm willing to buy at this price. I'm willing to sell at this price, right? So there's a bunch of people saying these kind of things. And then ultimately when you buy and sell, it connects you with those people that are making these offers. Now, that kind of a model really works when you have markets with high trading frequency. So everybody's like, all the time, trades happening.
Yeah.
And there's like this kind of class of people that make these kind of markets work, called market makers, who set the majority of these buy and sell orders. And it's a very good business because you have like good trading frequency. Eventually, if you know what you're doing, you're probably making money off of this.
Right.
The problem is when you have these kind of markets with lower trading frequency, now what, right? Because the market makers aren't necessarily like too incentivized to come in and do all of this market making because it's a very different kind of profile of thing that they have to do, right? So that means that you end up with kind of these like order book approaches for carbon markets that don't really work because it doesn't have liquidity anymore, right? Because there's no buyers and sellers like at any specific moment in time.
So just to recap, traditional way of creating markets was order books, matching buyers and sellers. And this works great in high liquidity environments where there's a lot of demand and supply. And there's a role, people come in as market makers and help to smooth out that matching. And they make a lot of money in arbitrage, by providing that function and liquidity. But this style of order book exchange isn't very good for low liquidity environments, where there's maybe not as many transactions happening between buyers and sellers, or there's a token or a stock or whatever that just doesn't change hands very often.
Yeah, it doesn't change hands at the frequency that makes order books really work, right? So in DeFi, we had this great innovation called a automated market maker, which is a structure where instead of having this organization that does a bunch of very complex math to figure out like where the buy and sell orders are supposed to be, it's a more simplified model where you have, for example, two piles of assets, like, let's say token A and token B, and mathematical equation in the middle saying, hey, if I have a lot of token A but not a lot of token B, I guess that means token B is very valuable compared to a token A, because I am assuming that both of these sides have equal value, right? So now if you disagree, you can come in and deposit and kind of rebalance these two pools, and you pay me a fee to do that. So that's the whole system there, right? So we have people putting money on the table and then saying, hey, if you want to rebalance between these two piles, you can pay me a fee, the market's here. And that's how you create a market from zero, and you bring the market to actually liquid in a very short period of time, without having to have order books, right? Because you can just put money on the table and say, like, there's the equation, everybody can see it. And these are the terms.
Yeah, it's so funny because I have a couple friends who are just sick of me talking about AMMs. Like, to me, this is like one of the most profound innovations that Web3 and crypto and DeFi has brought to the world, that is still like, I just don't meet that many people who have really incorporated this into their thinking. But the ability to create markets in low liquidity environments, I think token bonding curves is also quite profound in this. And we had an interview with Griff Green that touched on that if people want to check it out. But yeah, it's like, and it's not an unproven concept. It's not like we're just drawing this on a chalkboard. This is like, I mean, Uniswap is cleared over $1 trillion or something in trades now. Like, and Uniswap obviously being the main protocol that has brought AMMs into popular usage. So yeah, okay, tell me more about how this applies to Solid World. But I'm with you on, like, my inner geek is just so excited about AMMs.
Yes. In the carbon markets, we actually saw this concept even being proved out about a year ago, because when Toucan and Klima launched, this was the innovation that they leveraged to create a market out of nowhere, right? There was never any order book. There weren't like centralized entities going like, these are the prices. There was nobody setting prices. The market was setting prices. Because if you have these two piles of money on the table, ultimately how you figure out price is just supply and demand. Like, are people buying or are they selling? Like, the price will go up or it will go down. There are challenges with this. Because if you don't have a source of incentives for liquidity providers in these like low frequency environments, it might necessarily be too profitable to be this kind of liquidity provider, right? Because you aren't there aren't like the proper incentives. So you could even like lose money by just having like the value of the two,
Impermanent loss.
Yeah. Well, for the audience, I think impermanent loss is something that it's going to take 10 minutes to describe properly, but I'm going to try to do it in 30 seconds.
Okay.
All right. So we have these two piles of tokens, token A and token B, and we have a math equation, right? And impermanent loss is essentially, well, if I just held the two piles of tokens without, essentially allowing people to pay me for rebalancing them, would I currently be richer or poorer, right? And when the price between these two tokens gets to the same level again, you will have the exact same two piles, at which this point there's no loss. But the further away, like one pile keeps getting smaller and the other one keeps getting larger, you're gonna see some level of this kind of impermanent loss happen.
Right.
Yeah, because essentially what happens is that when some sort of a token is getting more expensive, you are selling all the way up. And when some sort of token is getting cheaper, you're buying it all the way down.
Right.
So that's where impermanent loss comes from. But the cool thing about the math here is that if the price gets back to the same level where it was before, you have no impermanent loss.
Right. Okay, so let's just break it down simplistically in an example to make sure that people are following, like, a basic construct of an AMM, and then we can touch on impermanent loss. So let's take Ethereum and USDC, a very popular US denominated stable coin. And so the Ethereum price, let's say, is 2,000 USDC for every one Ether. And so how does it work in terms of this math that you're talking about? And like, let's walk through the ETH and the USDC and this AMM.
So let's say we start out with $2,000 and 1 Ethereum, right? So those piles have equal value. That's how a basic, what is called a fixed product market maker generally works. You assume that the two piles have equal value. Now, let's say the value of Ethereum goes to $4,000, right? So because you were essentially selling all the way up, you might now have only, let's say, 0.5, 0.6 Ethereum on one side, and you might have like $3,000 on the other side. So like now, instead of having this like math
2,400 on the
well,
USDC.
yeah, it essentially, like, the math here might be exactly something like you might have 0.6 Ethereum and maybe like $2,400. So even though your position gained value, it didn't gain value at the same speed of just holding the underlying things.
Right.
So that's where impermanent loss comes from. If anybody has ever participated in the fun degen stuff that DeFi people sometimes engage in, if you provide liquidity to a token that's going to zero, well, you get to be on that ride even harder, so that's fun.
Right. So the reason to participate in this as a liquidity provider is that I'm getting a portion of the transaction fees every time people make exchanges. So I'm putting up some ETH and I'm putting up some USDC. And the reason I do that is then you come in and you're trading back and forth. And when you trade 1% or 0.5% or some small fraction of your total trade amount is transaction fee, just like if you were going to an exchange. And that transaction fee, I get a portion of that. Uniswap gets a portion of that, et cetera. And so I'm basically earning money for putting my liquidity up in this mathematical formula.
Exactly.
But if I go provide a bunch of liquidity for a crappy token that just sinks in value, then even though I got some trading fees, I actually might have ended up worse off.
Yeah.
And so these market makers, these DeFi degens, the decentralized finance degenerates, are effectively playing these games to provide, and I don't mean that disparagingly, it's a self-described term for within DeFi.
Yes.
They're playing these finance games in order to provide liquidity to get fees from the trading, to essentially earn yield on their liquidity.
Yes. And as far as like degens go, I think they're a very necessary part of the ecosystem because
100%.
we have needed like people on the frontier of these kind of experiments to come in and participate and like take that risk in order to prove out that, hey, these mechanisms work, like which one of these is gonna end up working and changing the world.
And part of the reason this has been so profound or innovative is that in traditional equity markets, to be a liquidity provider was not something that anyone in their basement with a mobile phone could do. It was like, so what we have now are like new tokens being created, and then all of a sudden liquidity able to be incentivized to back those tokens in order to essentially create this like permissionless environment where we are able to stand up new representations of value. And so that just means like the stage is set for a Cambrian explosion of programmable tokens. And as long as this doesn't just get completely shut down by nation states, it means that we can get to that vision of programming our values into our currency and to let the evolutionary process work, where we can effectively find new ways of incentives and coordination and programmable value that can achieve the aims that we're trying to achieve.
Exactly.
And so now it comes to Carbon.
Okay, so now when it comes to Carbon is a very interesting use case for AMMs because it doesn't have that challenge of, hey, the token might go to like 0 to infinity, right? Like that's not the range that we're operating in. It's something more, expectable, like, it might like 2x in value, but it won't like, 100x in value. It might 3x in value. It won't 1000x in value, right? And there's this second very cool innovation that Uniswap pioneered called concentrated liquidity, which is I am only market making in a certain price range.
Right.
And what that gives me is I could make that money give people even better deals in between that range, and I get to be the person collecting more fees, essentially, right? Because I get to set up better transactions for people. The thing with these kind of systems is that the more you buy from it, the more expensive it becomes, right? So like if I want to buy 100, I won't really affect the price. If I want to buy 10,000, I might affect the price a bit. If I want to buy 100,000, I might make the price go insane, right? In this kind of concentrated market making solution, we can make that movement in price a lot slower. So that means people can buy and sell much larger transactions in without moving the price as much.
Right.
Which means we can end up with a even more liquid, even better functioning system.
Right. So these are all steps on a journey of creating highly robust, highly liquid carbon markets and environments where liquidity can be more fungible between carbon projects, which allows us to bring forward money to finance more projects.
Exactly. Now, the last part of this, we have to talk about incentives, because historically, market making with like zero incentives might not be that attractive. So we have to think about like, okay, but who's going to pay for it, right? Because like you could think about liquidity as a sort of public good almost. Like I think I would even argue that for climate action, liquidity is a public good. Like it's a form of public good.
Yeah.
If the projects can access money better and easier and faster, that is a public good. The market after that can take care of the price discrepancies, but ultimately the ability to even trade without going into like a 3-month negotiation on what the appropriate deal term should be is special in and of its own.
Right.
But yeah, where do the incentives come from? So at Solid World, we have this, a couple of interesting innovations, but one of them is just the fact of, I'm reminding you of this discount, right? So before we talked that when you are 5 years away from issuance, you might only get like, let's say 0.6 CRISP-M for every 1 ton. And now you've essentially deposited that ton into the CRISP-M treasury. You could think about it this way, right? So that forward contract that just got deposited is being held by the smart contract, right? Like the thing that CRISP-M represents, you can use CRISP-M to buy that out, right? As we discussed before. But now, as this contract moves closer and closer to maturity, the number of CRISP-M you would have to pay for this increases, right? And the cool thing about that is actually we can capture that increase in the exchange rate, and we can distribute this to the liquidity providers as a source of sustainable incentives.
So if I bought a ton 5 years delivery away, and I only got 0.6 CRISP-M today instead of 1 CRISP-M. Sorry, how much does a CRISP-M represent?
You sold you sold a ton, or you...
No, if I'm a buyer of carbon credits,
sure,
and I buy something that's going to be delivered 5 years from now, then I'm only getting, call it 0.6.
You only have to pay 0.6 CRISP-M for that 1 ton.
I only have to pay 0.6 CRISP-M.
Yes,
I see. But I'm not taking a CRISP-M token. I'm paying CRISP-M.
Yes, exactly.
I see.
You are getting essentially these tokens from the market, this like market making mechanism, right? And you're exchanging that for the underlying contract.
What are the tokens I'm receiving?
The tokens that you're receiving in technical terms are ERC 1155s.
Called what exactly?
We call them forward clips. So essentially, these are representations of a specific contract.
Got it.
So it's the vintage, delivery date, and the project, and who is the project coming from. That's kind of what that represents. Well, CRISP-M is just essentially a sort of tokenized right to redeem the underlying contracts.
Got it. Okay, so you're saying that I paid 0.6 CRISP-M in order to get that, but then as we move through time, that 0.6 would actually cost 0.7, 0.8, 0.9. And that delta, that difference between what I paid and what it's now worth, you're finding a way to take that value and use it to incentivize the liquidity providers.
Yes, because when the suppliers deposit their contracts and nobody has bought them out of the system, as they in the system they essentially get closer to maturity, it becomes more expensive to buy them out. That's what this mechanism achieves, and that excess value is distributed to the liquidity providers as an additional incentive.
Where does that excess value find its liquidity?
Where does that excess value find?
How is it distributed to those liquidity providers? They're just sharing in the token representation.
Oh, that's what you mean. Okay. Yeah. Yes. So we essentially have a reward staking contract where you bring your liquidity to.
Yeah.
And in a non-custodial manner, so you are not giving that liquidity to us. We never hold your fiat. We're not an exchange in that sense. Like we're not the counterparty for your trade. We don't hold fiat. That's code. And we just know that on a weekly basis, we are distributing this many new CRISP-M tokens to the liquidity providers, and you essentially just opt in to receive them.
Got it.
Yeah, and that's also purely handled by code.
Right.
The way to think about this is what this system is. It's a sort of like a warehouse for these forward contracts, right? So the supplier brings the contract to the warehouse gives them a token. Now a buyer can come in and give tokens to the warehouse, and the warehouse gives them the contracts. But while the contracts are in the warehouse, right? While nobody has essentially like bought it yet, these contracts are getting closer to maturity,
right?
Which means that value can be captured and redistributed.
Right, got it.
That's the logic there.
So it's basically the photosynthesis process is creating the value.
Yes, time is creating the value.
Time is creating the value, and then as that value accrues, you're giving a portion of that to the liquidity providers.
Yes.
Fascinating.
Yeah, and then I guess the last question is how does Solid World make money out of any of this? Right. I think that's an important question. We make fees from the system, so we have low fees on the supplier side, and then on the demand side we have a 5%, approximately 5% fee for redeeming supply.
Got it.
So for us, it's like the value add should come from the buyer side.
Right. So how much do you charge the suppliers?
It's about 2%.
Yeah, I think that business model is very straightforward and feels incentive aligned, because basically Solid World succeeds if there's a volume and value being created on this marketplace. And yeah, I mean, it took me a minute to just walk through it, but I appreciate you explaining it, and hopefully people will have been able to follow or receive value from that. I think it's, at a high level summary, it is just the nitty gritty mechanics of how do we build carbon markets on chain using some of these new innovations in DeFi and token representations. And so, I don't think people have to understand all of the mechanics to really still participate in the system.
Exactly.
You can buy carbon credits, you can get them delivered, you can supply liquidity, and if you were a liquidity provider, you probably need to really understand this stuff better to know the risks you're taking. So like what's the current scale and volume that you have in the system?
So we launched with $1 million of liquidity. So that essentially means there's currently $500,000 on the table, and there's $500,000 worth of forward contracts from very high quality mangrove restoration projects available right now.
Great.
What that essentially achieves is, for example, if an organization wants to come in and buy 5,000 tons of very high quality mangrove restoration, let's say a year away from now, they can come in and buy that essentially at a discount to the current prices.
Right. And you're based in Estonia, is that correct?
Yes.
Yeah. And so my understanding is that, forward contracts in the carbon markets obviously, get entangled with the consideration of around regulatory and securities laws. And so you've done work on this in the Estonian context. Can you share more about that?
Yeah, so we have been very lucky to work with the legal arm of PricewaterhouseCoopers in Estonia. They are excellent at what they do, and together with them, we have navigated and talked with the regulators directly. So we have non-binding legal opinions directly from the regulators themselves on our legal status. And currently, we are not a security. Though we are still regulated under standard consumer protection law, so functionally we can't misrepresent reality, we can't do fraud, like all of that's still very illegal.
Right.
It's more of like this kind of contract where we're just agreeing that you will receive delivery for some good at a later date.
Totally.
Yeah. Pre-purchases.
Right. And so out of those three actors in the ecosystem, the suppliers, the buyers, and the liquidity providers, where do you see most likely the bottlenecks emerging? Or which side of that three-sided marketplace is going to be the least likely to scale as quickly?
That's a very good question. So how I personally think about it is what carbon projects will always need is money on the table. So I think if we can solve for the other two properly, the supply essentially will come.
Right.
That is my belief.
Yep.
Now, when we're talking about the liquidity providers, I think there's a sort of Lindy effect for the audience. Lindy effect is essentially the lifespan of a mechanism not breaking down is essentially it creates the feeling of trust and security that it won't break down in the future, because generally you end up seeing systems either break down very fast or not at all.
Right? Yeah, people say Bitcoin and Ethereum have more Lindy, they've been around longer, and so they're higher trust.
Yeah. So I think over time that will definitely increase access to capital and the cost of capital in the middle as the perceived risks go down. So I think that part is generally quite scalable.
Yeah.
And on the demand side, we're quite optimistic, but I think this is a bit of like longer process of also developing this trusting relationship with the demand, but also collaborating with a bunch of demand side marketplaces in order to expand and get in front of as many potential buyers as possible.
And who are those main demand side marketplaces?
So currently we have, for example, Neutral Protocol. They're launching soon. Senken is out. Fallow, I believe, is out.
And these are all mostly Web3 groups. Yeah,
exactly. But the thing that they are essentially innovating on has to be the buyer side experience of making that as low friction as possible.
Right.
Because, for the Web3 crowd listening, I'm sure you all know the user experience challenges of existing in Web3. But I think ultimately we're going to have to move to a more what is referred to as a Web3 mullet, which is, very familiar, very easy to understand interfaces in the front and all of the complexity and the Web3 stuff happening in the back without you having to understand that.
Yeah.
That's what's happening there.
Yeah. And okay, so I want to talk a little bit to the broader perspective you have about the demand side, because I think a critique within the Web3 carbon credit ecosystem is that we don't actually need to just create kind of like new wallet, liquidity interfaces to get demand into carbon credits. That's actually, not the problem, even though that's received a lot of focus. I mean, I've heard this critique a few times, either because they're making the case that it's actually the origination of high quality projects that needs to be the focus, or because this is not, targeting the Microsoft sustainability team to buy a bunch of carbon credits. It's not a question of like, do they have a streamlined, Web3 wallet experience to go in and buy those credits, right?
All right.
What would you say to those?
I love that question because I think ideologically I have a very different perspective on this. Because I've seen a bunch of registry style plays over the last couple of years. I've had this benefit of just watching from the sidelines. And what my general impressions are is Microsoft, Stripe, these are organizations that are kind of on the frontier of how sustainability finance is happening. But when you go to the average sustainability team, they are an incredible amount more conservative than Microsoft or Stripe. They have guidelines on what exactly they are allowed to buy from what registry, what does it need to look like, what are the approved methodologies, what do they care about, what are the SDGs, blah, blah, blah. It keeps going, but they have strict boundaries they work within, and that limits their ability to essentially operate in the market. A lot of the time, these people that are making the buying decisions aren't necessarily the same people that can change the policy around the buying decisions. Right. So I think there is actually a lot of there's definitely a wall you hit as a registry after you've managed to sell to your friends in Microsoft, right? Because when you get to the average corporate has a very different kind of more conservative perspective on how they interact with things, and you need to fit a certain kind of framework or boxes a lot more clearly in order to make that work.
Right. And I guess, what I'm stuck on is also like the motivation that you described at the beginning of this conversation, which is really they don't want to get the negative reputation hit of having bought carbon credits from a project that blows up or doesn't deliver. And so it does seem like a recurring theme in conversations I'm having in this space, where people are acknowledging that the buyer motivations are heavily influenced by reputation.
Yes.
If not purely being motivated by that. And so that makes sense when we're operating within a fairly limited voluntary carbon market paradigm. My first question is, do you think that is going to fundamentally change over the next, call it 5 years, because we actually are going to move into a compliance paradigm where these corporations are forced to buy credits, and so therefore it's not going to be a question of, will I get in trouble from a PR perspective because the Guardian is going to run an article that says the forest that I bought carbon credits from burned down, but it's more like, do I meet these 15 standards that the law requires in order to buy credits that meet that certification, and then therefore like I just have to do it that way, like because that's a completely different type of buyer motivation.
It's, I think, a lot more complicated than that, because let's take a very narrow example. So airlines, right? So airlines have this set of guidelines that they need to follow when they're buying offsets already. So that's called CORSIA. And under that framework, sure, there are a bunch of organizations going after the lowest common denominator, but they're still exposed to the exact kind of like optics risks that come with financing climate action that wasn't very real and didn't properly affect the local communities. They are the exact same amount of exposed. In Australia, they have their own crediting scheme, which includes the voluntary carbon market. Same story. I mean, ultimately, the organizations in Australia that bought carbon credits from the Knight project, which is a REDD+ project in Papua New Guinea that got written about by the BBC under the title Carbon Colonialism. Those organizations were still exposed to the optics risks of this project being, perhaps not as good as everybody thought it was going to be, right? So the risks in the voluntary carbon market are still, who are you giving your money to? Like, what is that organization doing? Is that good climate action? I think that still sticks around unless we're really talking about these kind of cap and trade style schemes where the credits don't come from projects, they come from politicians deciding how many credits exist, right? So in Europe, we have this thing called the ETS scheme, where a bunch of organizations just get assigned a number of ETS credits, and they can use this to justify their emissions. And if they want to emit more, they have to go out and buy somebody else's allowance, right? So this kind of a scheme, the climate action necessarily doesn't even really happen. It's just a way of pricing the emissions instead of supporting the projects reversing the emissions.
Yeah, and I'm inferring from the way you characterize this that you don't think cap and trade is necessarily the best idea.
I think cap and trade is a completely fine idea, but cap and trade, just like the voluntary carbon market, it's not a complete breakfast on its own, right? So if you drink 2 liters of orange juice for breakfast, not a complete breakfast. If you keep doing that, that's not a good idea. Ultimately, if you're participating in the voluntary carbon market as demand side and you are an organization that deeply cares about sustainability, carbon credits are a very good and necessary tool because your organization will likely never get to zero independently. Right. You need some help with that.
Right.
But your goal should be as much as possible to think about what your organization in its daily activities is doing.
Right.
And then the voluntary carbon market is a sort of supplement on top of that. It's not the whole meal, right?
Yeah. We had a conversation that covered a lot of these same themes with Paul Gamble from Nori, and I think he said something like their tagline was emit less, offset the rest. And that really the first order of business is to decarbonize as much as possible and to reduce one's emissions. And then, what we're acknowledging and recognizing is that it's going to be effectively impossible to not, emit or to have environmental footprint for a lot of activities that we engage in our current modern industrial contexts. And so therefore, carbon credits represents a mechanism to basically fund projects that are hopefully more in the nature-based, but also there's obviously technological solutions to offset, to take responsibility for the carbon that's been emitted.
Yes. And now finally, let's talk about timelines, because I think timelines is fascinating. Because
before you go there,
all right,
I'm still stuck on the reputational thing.
Okay.
What I heard you say was basically it's both. It's that the buyers of these carbon credits are going to, or you said basically they're always going to have to consider the reputational, context. So I'm still stuck on the question of, do you think we're going to move into a compliance paradigm? Where maybe, yes, they still need to worry about the reputational, but do you think that this is just going to be regulated as a forced function for purchasing offsets? Broadly speaking.
I think we're seeing some evidence of that, but how that's going to play out, I think, is over the next decades. I don't think there's anything really realistically coming down the pipes in the next couple of years in the US or Europe. There are some countries that have gotten a bit further with this.
Got it.
So in the EU, for example, we have this legal process for creating a legally recognized removal credit. But that process seems to be in its early stages, so that is going to take a while.
Got it. And then on the reputation side, why do you think that there's been such so much critique of carbon credit projects that don't live up to their promise? Because when I think about the amount of greenwashing done of, let's say, in the organics movement, or now in the regenerative agricultural space. Like corporations have been greenwashing their environmental impact as long as we can remember. And so, there doesn't seem to be like a new article in, you name the publication every week about like, well, actually they sprayed their crop with this and so they're not truly organic. But yet carbon credits are subject to that scrutiny. And the reason I'm asking is it just because it's so new and that we're just going through this like beginning stages, or is there something else going on?
I can answer this in a couple of different ways. So one of them is I think from a mainstream media perspective, they just don't really like climate activists when they're using economic mechanisms, right? There's a sort of schadenfreude of going like, hey, like this person really fucked up and they should be punished and we all hate them now, and not recognizing the work that they're doing, because ultimately I think a large portion of their readership want this confirmation that we're doomed and there's no point in trying. That makes them feel safer to some extent, right?
Spicy take, Rez.
Yeah, there's like some safety in giving up ultimately and going like, no, everything's just gonna get worse forever and we should stop trying. And like, I think a lot of people just want to see that message, actually, just completely unironically, because sipping margaritas at the end of the world seems a lot nicer than
rolling up the sleeves.
Rolling up your sleeves and trying, even if you think the outcomes aren't going to be fantastic for everybody, right? Like it justifies inaction to some degree. It's this kind of like schadenfreude of, look at these people, like they're not doing well, we should give up. Like that's the message.
Wow.
And
I think that's a really profound reflection for the environmental movement to really take to heart. But please keep going.
Yeah. The second part of this is just, I think greenwashing is a challenge because if you end up with a bunch of these organizations that are very not picky about the kind of offsets they're consuming and end up going for the lowest common denominator on the market, like even at the moment where we're purchasing it, there's a large amount of like voluntary carbon market participants already going like, you shouldn't have done that. That's a bad idea. That's not gonna end well. Like everybody knows this, and it's kind of this, even from the like inside, it's kind of like painful to watch sometimes, because you see these organizations say like, well, why should I go through all of this effort of buying $15, $30, $500 credits when I can get something for $2, right? Like $2 is affordable. Like my budget is this, and we want to do climate action, so my budget is this, and I'm gonna put my budget into the thing that gives the biggest number, and that doesn't pay off well, actually. And if we didn't have media putting their attention on this, these organizations could keep doing it forever, right? And that's also not a future we would want. But it's just the balance of these two things in the media is very, I think, challenging to strike, because how do you package that kind of a message in a way that isn't everything is hopeless, let's tear everything down, let's give up, like let's wait for the regulators for the next 10 years to figure out in repeating summits of like what should be done. I mean, we can either just sit on the sidelines and wait and vote and hope that things will keep moving, or we can come in and try and do something and move the space forward.
Yeah. So it sounds like, the criticism is often deserved and healthy for us to, put sunlight as a disinfectant on low quality climate action carbon space. While we don't want to also just veer off into, completely cynical, if it bleeds, it leads headline incentives. And we just want to have an honest, real examination of, are these projects delivering what they say they are, so that we can create integrity in this space?
Exactly. And if the listeners want to contrast and compare what like good messaging versus bad messaging looks like. I think the most stark example is when John Oliver covered the voluntary carbon markets and cook stoves. He was aggressively critical, had this sort of grave dancey vibe to the whole thing, and ended up, I think, being very unfair in his summary assessment because he was just emphasizing the things that have gone wrong. While there's this nice YouTube channel that generally does logistics videos, which I've been watching for a couple of years, called Wendover Productions. I don't know if you've ever seen this channel.
Windover Productions.
Wendover Productions. So
Wendover.
yeah, and it was like a video called "Are Carbon Credits a Scam?" And it was very critical also about carbon accounting and how challenging it is, and all of these challenges. But it ended up educating the people on what quality looks like, and it didn't end up going like, and everything's hopeless and we should give up. That's not the conclusion you should come to. But if you're part of the mainstream media, that's the prevailing narrative is no, give up on everything. Look at all of these negative examples. And nobody's going like, well, what about the actual positive examples? Has anybody? Nobody wants to read about that, and so it doesn't get reported on as much. But there have been profound, great consequences of the voluntary carbon market existing. I had a fantastic chat with Gregory Landua yesterday from Region Network, where we were discussing just the concept of. So in the voluntary carbon markets, we have this concept of leakage, which is, in the simplest way to explain additionality permanence leakage. Let's say I run this very bad carbon project, which motivates you not to drive your car. So if you don't own a car and I pay you not to drive your car, well, then that's not very additional. You couldn't have done that in the first place, and you weren't doing that in the first place, right? We need evidence, historical evidence that something has changed now that I am giving you this incentive, right? Permanence is just the fact that if I pay you not to drive your car today, but you drive twice tomorrow, we've avoided those emissions for one day. Not very permanent, doesn't achieve much. The last one is leakage, which is if I pay you not to drive your car, but now your partner drives you around everywhere. Well, you're not driving the car, but we just kind of did this accounting maneuver where we put the emissions onto somebody else, right?
Right.
So he mentioned this. We were discussing this concept of positive leakage, which is just the fact that carbon projects themselves existing make people behave in a more positive way because they have this expectation of like, oh, maybe I can also get credits, right? Like it's this kind of interest of like, well, maybe this land has some different value as well. Like,
totally.
Yeah, maybe I can afford to consider my options instead of chopping down a forest or.
100%.
Yeah.
Yeah.
So the existence of these mechanisms themselves has, I think, already done a lot of good. And then not all carbon projects have really, I think, delivered on the vision of what they should be. Right. But the ones that have, I think, should really be celebrated.
Yeah. Yeah, I agree. And for all of my perpetual critiques on this interview series of the New Zealand ETS, hearing one of the regulators of that program speak on stage at a conference recently by Pure Advantage. And he said, before the emissions trading scheme, we would register, most of the work we were doing was registering deforestation filings. And that's like really radically decreased since the introduction of these carbon markets. And so even though, yes, there are all sorts of limitations and shortcomings of the way that it's currently designed in New Zealand, if you zoom out, over the last 10 years, we've made a lot of progress. And I do think that that's an important part of the message here. Getting to that narrative nuance, like I do think it's somewhat the environmental space is, I think, trying to stomach carbon credits as a possible tool and solution still. It's like we haven't really accepted like that this is something that we're really signed up for. And I mean, I'm overgeneralizing something that can't be spoken for everyone, but that's just my experience. Like when I was down in Ecuador, and now Ecuador for the first time is going to open up its carbon markets, whereas before it had essentially a moratorium on this. And, you're hearing indigenous communities also kind of be like, yeah, our position before was we don't want to commodify nature and we don't want to see carbon markets. And our position is softening and becoming, actually, this is the most logical mechanism to get paid to protect our forests, and so it does seem like we're just going through a little bit of an acceptance process. And yeah, I mean, fortunately, we have John Oliver scheduled right after this on the show, so we're going to talk to him about if you're listening, John, which is 1 in a billion, yeah, we want to talk to you about the narratives of carbon markets and how you're critiquing them.
Yeah.
Okay, so you had wanted to make a point about timelines. Yeah, where were you going with that?
Fantastic. So a bunch of organizations say they're going to be carbon neutral by 2030, let's say, right? And many of these organizations haven't necessarily done a lot yet.
Right.
And I understand that when you have huge organizations, it takes a lot of time to decarbonize anything, because just steering the ship 1 degree to the right might be a gargantuan task,
Totally.
right? And well, 2030, cool, okay. Now, if you're just like looking for spot carbon credits, like from high quality projects in 2030, and like nobody's been working on financing these projects, how is everybody getting to 2030 like being carbon neutral? I don't get that part, right? We need quality climate action to happen right now, because for a lot of this, the credits that are going to be created are around like 2030. They're not now. They're not even like next year. When we're talking about growing new forests, the majority of the carbon sequestration is going to happen in 10 years. So from that perspective, we need stuff to be happening right now, because ultimately, if we want to reach those goals and we want to make those options available, and it seems like everybody wants high quality climate action, we need to do something now instead of in 2030, because that means we'll have reforestation initiatives which are creating a significant amount of credits in 2040, which, I don't know. Every time somebody says that they want to be carbon neutral by 2050, I think that's like, oh, okay, I'll quit drinking when I'm, on my deathbed. That's fantastic. I love it. Good system. We'll all be dead by then. I don't care about 2050. I care about now. What are we doing in the next couple of years to actually steer the ship the 1 degree that we need it to be steered in order to get those outcomes?
And when I think about, would I buy credits from Solid World because I believe that I'm going to need those credits in the future, and like I'm not just running it through the lens of like, will that mangrove project actually do what it says it's going to do? I'm running it through the lens of like, will Solid World be around, and will those credits be recognized by the market, and like will the legitimacy of the credits themselves and the representation of those credits, how do you think about that?
This is actually one of the reasons why we limit forward selling to 5 years right now, because the uncertainty horizon past that of like what exactly is that going to look like becomes much more unpredictable. I think maybe like 3-4 years forward, we shouldn't be expecting like very dramatic shifts, but obviously there are some headwinds in some directions which can change the landscape, right? So we also want to be quite mindful of this. The second element is the way our contracts are structured. We can reassign delivery without having to be in the middle. So ultimately, us existing or not existing is not material to the execution of the contract.
Because it's done through smart contracts and decentralized liquidity providers?
That's the dream.
Yeah.
We do have like a real life legal component when it comes to delivery right now. That generally comes due to the fact that Verra doesn't allow tokenized carbon credits right now. So when delivering forward contracts, that actually needs to happen through like real life entities.
Because these are Red Plus?
No. So what Red Plus is, just for context, is these are forest conservation projects.
Right.
We're talking about,
mangroves.
Mangrove restoration projects. Yeah.
Right. So why do you have any entanglement with Verra in that?
Currently, not that much.
But you said Verra doesn't allow for tokenized.
Well, they don't allow for tokenized carbon credits for whatever reason that they have right now. it makes delivery a bit more complicated and more multi-step than it should be. But we have contingencies to handle that situation.
So part of the reason that the legitimacy exists for your credits is because you are delivering Verra certified credits. Is that correct?
Yeah, our suppliers are delivering Verra certified credits. They are going through existing processes. They're going through the most traditional, most understood process, because ultimately that means these more conservative sustainability organizations don't have this issue of when they have their checklist that says, is this Verra gold standard or CDM? Like, which one of the three is it? Because I don't have another box I can check for the for the purchase form.
Right. Okay, got it. And so, touching on that fact that Verra doesn't allow for tokenization of carbon credits, so that's something that happened, last year, and was somewhat a response to the blow up of Klima. Is that kind of roughly correct?
Yeah. I get the impression that a lot of it was due to the kind of supply that was coming in. It was Verra credits that Verra had clearly certified. They had the stamp of approval, but the voluntary carbon market in general didn't have a lot of acceptance for a lot of the supply. So that ended up in a situation where it was really looking bad because it was creating a lot of attention around the fact that this bad supply even exists and it was circulating. I mean, it's kind of, pulling up these bad memories.
Totally.
So one of the major examples were the HFC 23 credits. So for the listeners, there's a bunch of different other greenhouse gases, and they are also included in carbon credit crediting schemes. It's not just CO2. So one of these is HFC 23, which is a hydrofluorocarbon, and if I remember correctly, they are used in electronics such as refrigerators. They're a very nasty greenhouse gas.
Totally.
And they have, in the order of magnitude of thousands, tens of thousands of times more impact on climate change. On climate change than CO2. Yeah. So there was this cool methodology, which was, hey, these factories, we'd like you to destroy that gas instead of releasing it into the air, and we'll give you carbon credits. And then the consequence of that was there were a couple of, as I've understood, on-paper factories almost created just for the virtue of being able to destroy the gas so they could get the carbon credit. So really perverse incentives. They ended up issuing a huge amount of carbon credits, which are functionally worthless. They got the stamp of approval, everything was fine, and then Verra realized that this was happening and they discontinued the methodology. So no new credits, but ones that are still circulating, fair game, your risk, you figure it out.
Interesting. Yeah. My understanding of that with the HFC issue is that we need to dispose of our refrigeration equipment effectively so that we don't put it in landfills where it just breaks down and then releases all these gases into the air. And so, waste disposal around this refrigeration and these gases that have been put into these devices over the last few decades is going to be a very important task. It's part of our many different tasks to clean up. I guess that gets back to the philosophical contention with carbon credits in many ways is can we really create economic incentives? Are we just commodifying nature or creating abstractions and perverse incentives that the humans are always going to game, find different ways around, and we're just going to always be chasing our tail here rather than whole-scale revolution of our relationship with nature and doing things sourced from the pure motivation of love for the planet and desire to live in harmony with the natural world rather than make money a new way. Like, how do you feel about all that? And like, and I guess it also is a personal question, like why you're working on this space. Like you could be doing anything. You're clearly, very gifted and talented in the technical realms, and
Thank
so
you.
Web3 has like a boundless sets of opportunities. I'm not sure that carbon is like the number one money maker out there. Maybe it is, but it doesn't seem like it at the moment. So like, why focus here, and how do you think about this like this atomizing and commodifying and kind of financializing nature?
Mm. So I don't think we're necessarily chasing our tail as much as we're uh, iterating on an imperfect process because I think the HFC story emphasized also the fact that we can recognize that hey, that was a bad idea and stop. Vera shut down their existing RED Plus methodology. There's no new projects coming in under that. And the new methodology is significantly better because the main challenge, for example, for deforestation projects is how do you figure out the baseline? Like what would have happened if, you weren't around, right?
Right.
And right now it's the projects themselves doing a bunch of napkin math and reasoning about like, this is what I think the scenario should be, and then somebody signing off on that. But in the new methodology, the baseline deforestation rate is done by a third party who's not related to the project at all. So the way we set up these systems creates less perverse incentives, I think, over time. But there's a learning process because we're dealing with a very complex problem. And the way you deal with complex problems is you iterate because you cannot anticipate every single way anything can go wrong. But that doesn't mean you should stop trying entirely because the alternative seems clearly a lot worse. Now, when it comes to is this the best use of my time? I believe it is. I wake up in the morning and I have this feeling of I am working on one of the most important problems I know how to tackle. And it feels meaningful to me. And I think for a lot of people suffering from climate change-based anxiety right now, working on things that you can see are making progress is the best thing you can ask for in terms of your mental health. The question about radical change, the thing is that's also a complex solution ultimately, right? And like the implication that if we changed everything and now we're gonna get to perfect, I don't think that's very realistic. I think generally in history we've seen that revolutions are also followed by very turbulent times where nothing is really as nice and rosy as we anticipated it being. And that also doesn't mean we shouldn't try to make things better. I think I do have a bit of an incrementalist bent in that sense of something like a completely new and outside the box. It's an interesting territory to explore, but that doesn't mean it's necessarily going to be the answer that is going to get us the results in the timelines that we need to work in, because we don't have a lot of time. And if you ask climate scientists, they will even tell you that we are kind of out of time. Now it's just mostly a question of will we be like this amount of bad outcomes or will we be at like that amount of bad outcomes? So, how do we get to here? And I think very drastic things do need to happen. But I also think we need to essentially, what's like a good term for this? Spread 1,000 seeds, right? And hope that one of these solutions is going to get traction, is going to demonstrate the value, and is going to demonstrate the ability to actually achieve stated goals of lowering the impact of climate change to the point where humanity could survive it and still thrive. I don't know if that was like a complete answer to everything you asked.
I think it was a complete breakfast. Yeah,
Okay.
it was a very good articulation. I think people will appreciate it. And yeah, I appreciate you also sharing so generously with all my pestering of technical questions as I wrap my mind around what you're doing and how you're thinking about the space. And I do think, yeah, we've only just begun to hear, I think, from all the different contributions that Solid World is going to bring into the fold. My very last question for you is just wanted to touch on, you have a podcast series that you're co-hosting called This Week in ReFi,
Yes.
Which I'm excited to start tuning into. Maybe share a bit about what that is and your motivation.
Yeah. So over a year ago, me and a friend I met on the internet at the start of the launch of Klima, we essentially met in that Discord and we started chatting, and eventually we were having such nice, interesting, informative conversations that he said, hey, it seems like every time I have a chat with you, I learn something, so why don't we just do that as a podcast? And I was like, that's a crazy idea and I love it, and let's do that right now. And now we're about 30 episodes in. The format is very low effort casual, that's the vibe. We talk about things that are affecting the industry, the current news. We have guests on, they talk about their philosophy, they also comment on the news. It's a more this kind of laid back, mildly shitposty kind of podcast.
Great.
We do deep dives in technical details of how Vera's new methodology is doing something, or how public requests for comment were processed, or what's the newest news about the EU putting up some sort of regulations. That's generally the kind of vibe that we have there. We also celebrate the people working in ReFi and their achievements and progress.
Great. Well, people can find the link in the show notes. We'll link to it, and people can find it on YouTube. This Week in ReFi. Any final messages that you want to share, Rez?
Yeah. I mean, I think the only message that I really have is that if you are doing your best to stop whatever crisis you're looking at right now, I think that's admirable. And ultimately, we need more people. We need more of these kind of people that listen to podcasts like this, right? I mean, we need people to actually be engaged and interested and fascinated and willing to go into the rabbit hole of what does carbon accounting look like, or what are the challenges. And we need more people like that, because there's a lot of work and we don't have a lot of time to do it. I just also really appreciate this podcast. I think you're doing something great.
Cool. Yeah, and if you're listening, we appreciate you. Let's stay with the trouble together and make it happen. Thank you so much, Rez.
Cheers.
Awesome. All right, I'd love to hear what you thought of that conversation. Leave us a comment below, or come join our community Discord. You can learn more about Solid World at solid.world. There's a link in the show notes, as well as a link to the This Week in ReFi podcast that Rez co-hosts. If you enjoyed this conversation, you might want to check out the ones we did with Paul Gamble at Nori, Diego Saiz-Gil at Pachama, and Troy Carter at Earthshot Labs. You can find all of those conversations and more at maearth.com. Please like, share, subscribe. Let us know what you think, and I'll see you next time.